Hello everyone. Today we are going to start our new unit, that is unit 4 chapter 8, and it is chapter 8. It is about the cost concept. There are different varieties of cost which you need to know the meaning of their meaning of the cost and their concept, how they are meant to be. The first one is accounting cost. What do you mean by accounting cost? Whenever we are maintaining any kind of cost in accounting, we reflect it in the profit and loss account and the balance sheet. We all know this, right? So in this case, accounting cost means those costs which are related in the transaction of a business. You buy something, you sell something, that means you are recording those transactions in your journals, right? So whatever cost is involved in your buying of materials, in selling those materials, or whatever other costs are incurred in accounting process, that is your accounting cost. And this cost is also known as explicit cost. Explicit cost, why they are saying, because the accounting cost, in accounting we take into account only those costs which are related to the business, right? One feature of accounting is that it is a separate legal entity. When we say separate legal entity, means even if you are the owner of the business, your personal expenses or your personal cost will not be shown in the accounting cost, right? But then whatever is related to the business, whatever cost is related with the business, we are recording it in the journal. That's why it is called a separate legal entity. Now what is separate legal entity? Because the business and the personal accounts are separated. Even if you are the owner of the business, whatever money you have invested for the business, the money or the capital have to be shown as different from your personal investment or capitals. That's why it is called explicit cost. Why it is explicit? Because we don't take into account the personal records of the partner. Next is economic cost. Now economic cost is like a future cost. What is this economic cost? It will be easier for you to understand if you have known the meaning of accounting cost. Now, as I have told you, in accounting cost we record only those transactions which are related to the business, right? The personal expenses or personal cost, whatever is involved, is not recorded in accounting transactions, right? That's why it is explicit. But in economic cost, what happened is, whatever is given in the accounting transaction, whatever you are recording in the accounting transaction, the cost, the expenses, the profits, plus whatever the personal expenses, the cost, the profits are their personal, plus the accounting version will be added together to get the economic cost. So that is the difference between the accounting cost and the economic cost. So economic cost is also known as your implicit cost or imputed cost. Why it is implicit cost and imputed cost? Because the economist does not distinguish between the personal or the owners of the business and the business separately. They take it as same. That means the owners, whatever the expenses, personal cost will be there, it will be included, and whatever the accounting cost, profits, expenses will be there, that one also it will be included. That's why it is called implicit cost or imputed cost. But one thing you have to remember here is accounting cost is explicit and economic cost is implicit or imputed. Okay, so next is opportunity cost. Now what is this opportunity cost? There opportunity cost, for this opportunity cost there is one very good line you have to remember for this is, it arises only when there is an alternative. If there is no alternative, opportunity cost is the estimated earning of the next best use. When you see this word next best use, you always have to remember that it is a opportunity cost. Why it is opportunity cost? When there is alternative, when you have a choice to make, that is your opportunity cost. Now I'll give you one example for this. Now so many of you are student, right? You all are student for, and you are studying commerce, right? And some of you might be there who are working to earn some money as well as you study, right? But the thing is, when you are coming for classes, let's take it as an offline classes, not online classes. Offline classes, when you have to come to the offline classes, you are present in the class to take the classes, right? But if suppose you are working somewhere and you have to work to get the money or to earn the money, then in that case what happens is you are missing the classes, right? So you are giving some importance to that. That is, you are working. If you are working, you cannot come to the class, and if you are coming to the class, you are sacrificing your work, right? So that is known as your opportunity cost, which is giving you the more benefit. You have to see, you have a choice to make. If you are going for work, you are missing the classes, and if you are coming for classes, you are missing the work. That is the alternative, or the next best use is known as your opportunity cost. Hope it is clear. Next is short run cost. Now what is the short run cost? Short run costs are those which are meant for a short period of time. Now in this short period of time, what is there is any increase during this period is possible only by using the existing physical capacity more intensively. Now in this case, I have told you in your previous chapters as well that in short run one input will remain fixed and other can vary. Okay, in short run you have to remember that the input of one good will always be fixed and others will be variable. Others you can change it. The main difference, main point of short-run cost is that you have to remember is one is fixed, one is variable. That means if you are changing input, the combination of, let's take it as labor and capital. If you are changing labor, then the capital have to be fixed, or else if you are changing the capital, the labor have to be changed. Okay, so one have to be fixed and one have to change. That is happening in case of short run cost, and it is for a shorter period of time. Okay, now in case of long run cost, what happens? Long run cost is all the inputs are variable. Either you change the labor, either you change the capital. You can take your own decision how much you want to change the labor and how much you change the capital. That is the long run. You remember this very clearly. In long run, all the inputs are variable, and in short run, one input is variable and other one is fixed. Okay. Now next is fixed cost. What is fixed cost? Fixed cost is the cost which remains constant up to a certain level of output. Now how much level of output, how much your production is going on, it does not matter. That is, the cost is fixed. The very good example of this fixed cost is the salary of a worker in the factory. When you are giving salary every month, you are fixing some salary to give to the workers, right? So that is a fixed nature. Now when you are producing something, suppose you have taken a rent of one room and to make the production, then what happened? That rent you have to pay anyhow, whatever it has been fixed. It's not that in some month you will give less rent, in some month you will give more rent. It is not. If your production is more, you will give more rent. If your production is less, you will give less rent. It is not like that, right? So how much you produce in that room which you have taken for production purpose, then that production, how much you are producing, also your rent will be fixed. It will not change according to your production. Like if you have produced 1000 units of goods, that does not mean that you will pay more rent. If you have produced 100 units of goods less, then it does not mean that rent you will pay less, right? So it is fixed by nature. That means the rent, the salary of the staff you're giving, these are fixed. So it does not change with the volume of output or the value of production. Okay, so this is called fixed cost. Next is your variable cost. Now variable cost is, they directly vary with the level of output. When you are increasing the input, it will affect in the output. Now let's say, one example, if you have taken some goods, and those for the production of, let's say, some shirts. If you need raw materials for the shirt, you need cloth, right? If you want to make one shirt, you need to have 2 meters of cloth. Just supposing 2 meters of clothes you are taking to make one piece of shirt. Now if you want to make 10 units of shirt, 10 shirts you want to make, and for that reason, do you think that 2 meter of clothes will be enough to make 10 pieces of shirts? No. So your requirement is, you need to make 10 shirts. Then if you want to make 10 shirts, you need to have clothes, right? How much clothes you will be requiring? That is, if for one shirt is 2 meter, then for 10 shirts it will be 200 meters, right? So this way, how much you are going to produce, it depends on the how much you are requiring the input. If you need more output, you have to produce more in output, then your input also have to be changed. That is known as variable cost, and it change directly with the variation in the output. I'll repeat one more time. Example, I have given one shirt, 2 meter of cloth, right? It is enough for making one piece of shirt. Now, if you make 10 piece of shirt, 2 meters of cloth is not enough. So what you have to do is, this 2 meter of clothes have to be multiplied with 10 to get the 10 pieces of shirts. So this is known as variable cost, which is directly changing according to the change on the output. Next is your marginal cost. Now what is marginal cost? Whenever I told you that whenever marginal cost is given, marginal means additional, extra 1 unit if you produce. That is your marginal cost. Extra unit of output if you want to produce, how much marginal unit you will get. Additional cost to produce 1 additional unit of output. Okay, so marginal cost, let's take it the same example of variable cost. I have told you that one shirt and 2 meters of cloth, right? Now suppose if the total shirt you want to make is 10 shirts, right? So for 10 shirts you are requiring the quantity of input is 20, that is 2 meter into 10, that is 20 meters of clothes to produce 10 pieces of shirt. Now suppose that 10 pieces, instead of that 10 pieces you want to produce additional 1 unit, additional 1 output, that is 11. If you want to make it as 11 instead of 10, then how much cost will be required to produce that 1 unit of shirt? Okay, that is called marginal cost. Additional cost incurred to produce an additional unit of output. To produce only that 11th number, how much cost you will bear to get the output? That is called marginal cost. Now average cost is just the total cost divided by the quantity. That means whatever the total cost you get for making the goods or for producing the goods, whatever the total cost you get after calculating, it have to be divided by the number of quantity. And the total cost, how you get the total cost? Total cost is the total cash payment made for the input needed for the production. Whenever you are making the payment, what you require, that you have to purchase it. You need labor, you need machine, you need raw materials, all these things you have to purchase it, right? Cash payment, you have to make the payment to get those inputs. So that is known as your total cost. So total cost formula is actual cost into quantity. Whatever will be the average cost or actual cost, multiply with the quantity. So it is just the reverse of this formula. Okay, so hope it is clear. Next, we'll see the relationship between the average cost and the marginal cost. I have just written here AC and MC. AC means average cost and MC means marginal cost. So what are the relationship between these two? It is very, very important for you to know it. Now here, both AC and MC are derived from the total cost. Why it is derived from the total cost? Because if we don't know what is our total cost, how can you say what is your average cost and what is the marginal cost, right? So whenever the total cost is not there, you cannot know what is your average cost and marginal cost. To know the average cost and marginal cost, you need to know the total cost. So now here AC refers to total cost per unit of output and MC refers to addition to total cost when one more unit of output is produced. This is as I have explained in the previous slide. Now both AC and MC curve are U-shaped. Now you can see this diagram. I'll show you in the next slides. It is U-shaped due to law of variable proportion. Now what is law of variable proportion? Law of variable proportion is when you are changing the inputs, when you are changing the inputs to produce a particular output. Okay, you have to remember this, that the shape of AC curve, that is average curve, and marginal curve is always U-shaped. These are the three important relationships between AC and MC. What are they? If MC is less than AC, then AC must be falling. If MC is equal to AC, then AC is constant. If MC is greater than AC, then AC is rising. So this relationship you have to remember, and this will be much clearer to you with the diagram. Okay. Now before going to the diagram, you see the table first. What are the table it is showing? We need inputs. Okay. Then we need total cost, average cost, marginal cost. So as we are taking cost, that's why we are representing it with rupees. Okay, and these are the phases. Phases means what are the stages which we will see in the relationship between these TC, AC and MC. Now what are the outputs? In units you are getting. If you want to produce one output, two output, three output, four output and five output. So it is increasing, right? Now in this case of TC, total cost, how much you will have this output, according to that this TC will be given. So it is given here 18, 22, 27, 36 and 45, 47. Now how you are getting this AC into 1? That is average cost is how much? 18 into 1 is 18. 11 into 2 is 22. 9 into 3 is 27. 9 into 4 is 36. 9.40 into 5 is 47. So you have seen this with the help of the formula. You need to remember the formula also to know how it has been calculated. Now how this value of TC is coming? TC is coming from this AC. I have told you. That is 18 into 1, 11 into 2, 9 into 3, 9 into 4 and 9.4 into 5. Now how we are getting this average cost? Average cost is, what is it? Total cost divided by output. Now what is this total cost? 18 divided by 1 is 18. 22 divided by 2 is 11. 27 divided by 3 is 9. 36 divided by 4 is 9 and 47 divided by 5 is 9.40. So we are getting these values. So similarly for MC, if you can see, if you go back here, you see this is the formula. What is MC formula? Delta AC into Q divided by delta Q. Now what is this delta? Delta means change. Change in these properties. Change in AC into quantity divided by change in the quantity. Now see here, this is coming 6, 4, 5, 9 and 11. Now you have to put up the formula there and then you can calculate this. Okay. Now when you calculate this, you are getting these values. Now what will be the phases? First stage is what? when MC is less than AC. When MC is less than AC, you can see here MC is 6 and AC is 18. So it is less than MC is less than AC. So this is the first phase. Next is, here we don't have to see how much because this is all less, right? Now it is the same phase. That means this is following for the second one also, for the third one also. Now for the second phase, how much it is, what is saying, MC is equal to AC. You see, compare this, MC is equal to AC. Yes, it is. So it is the second phase. Okay. Next phase is MC becomes greater than AC. Now you see here, MC is 11 and AC is 9.40. That means MC is greater than AC, right? So this becomes our third phase. Now with the diagram, you can see here, these are the three important properties of this relationship between AC and MC. Okay, you have to know it very well. The questions might set from these properties only. Now when MC is less than AC, you have to see the diagram from this. MC, you see, when it is down, that means it is less, right? AC is up, that means AC is greater. MC is less than AC, what is happening? AC is falling, right? When MC is equal to AC, here it is intersecting, right? So this is the point where it is at the minimum point and it is equal. This is the second stage. Now you see, MC is higher, MC is going higher than the AC. Then when MC is going higher than the MC is higher than the AC, then AC is also increasing, right? So this is the relationship between AC and MC, and you have to see the diagram that the curve of AC is U-shape. You can see a U-shape AC, and if you see this MC also, it is a kind of U-shape. So the relationship between AC and MC and the curve, you need to know it very well. The relationship is these three. When MC is less downward than AC, then it is falling down. That means AC is also falling. When MC and AC is intersecting, that means they are equal. When MC is higher, then AC is also increasing, and the curve is U-shaped. Okay, so hope this one is clear. Next is the explanation of the diagram. It is given here. You can read very clearly. Now it is saying the same thing. When MC is less than AC, AC falls with increase in the output till the third unit of output. We have seen in the diagram, and the explanation is taken from the diagram as well as from the table. Till the third unit of output, MC was less than AC. If we can just go back, see, till the third unit, you can see till the third unit, MC is less than AC. See here, 6, 18, 4, 11, 5 and 9, right? So in this, till the third unit, it is less. MC is less, right? So AC is falling in that case. When MC is equal to AC, that is when MC and AC curve intersect with each other at a point A, that is here, this is equal, right? They are intersecting, that means that is equal. This is the second stage, and when they become equal, then it is known as your minimum point. When MC is more than AC, AC rises with increase in output, that is from fifth unit. Now from here you see, from this fifth unit, MC is becoming higher than the AC. Then if MC is higher than AC, that means AC is also rising. AC is also rising. Here you can see AC is rising. Okay. Now thereafter both AC and MC rise, but MC increases at a faster rate as compared to AC. Now you have to remember this, that marginal cost curve is increasing more as compared to the AC. As a result, marginal cost curve is steeper as compared to AC curve. Now you can see here, this curve, MC curve, is growing more faster than the AC curve. It is not that how much high it is going, okay? It is not about how much higher it is going. It is about how fast it is growing. So MC curve is growing faster than the AC curve. As you can see here, 11 and 9.40. The difference is almost about 2, right? So MC is growing more faster than the AC in the third stage. So hope this one is clear. Thank you.